Hello and welcome to this webinar, Inflation Scenarios and Asset Prices. My name's Sam Wiley. I'm a Principal Fellow in the Finance Group at the Melbourne Business School and the owner of Windlestone Education and Windlestone Consulting. You probably know that already. So there's a set of PowerPoint slides for this webinar. Here they are. If you don't have a copy of the slides and you'd like a copy, then please email me here at Windlestone and we'll send you a copy. So this is the sixth webinar in a series of webinars that I started earlier in the COVID crisis. The first webinar was about why investors should stay invested rather than pulling out of the market after it had gone down, because the response to the crisis of central banks, especially quantitative easing, would drive the market back up, and investors needed to stay invested to get the benefit of that. Then we moved on to the residential property outlook and why the RBA and others were predicting that property prices would go up by 20%, and my agreement with that. And we were focusing on low interest rates and especially on the federal government's term funding facility, the RBA's, I should say, term funding facility for the banks. Then we looked at inflation scenarios in the stock market and how important the evolution of inflation was for the stock market and the big questions about that. And it's really that we're returning to tonight. So this is a revisiting this earlier webinar after the passing of time. Then we moved on to the effect that low real interest rates, negative real interest rates, have on property investing and how good that is for property investing and how investors can take advantage of that. Then we moved on to quantitative tightening, which had started earlier this year, and the effect that that will have on asset prices, especially share prices in the US and Australia. And now we're back to inflation scenarios. Now let's see what we're going to talk about through the webinar. First of all, we're going to focus on why inflation. Why are we focusing on inflation? It's not always about inflation. Ordinarily, there would be other really important scenarios about whether the global economy or the US economy is slowing down, whether we are having a financial crisis like the GFC, whether there is an asset price bubble, such as in the dot-com bubble, or other factors. Ordinarily, it's not all about inflation, but it's all about inflation at the moment. And that's the center of our talk tonight. So we'll work our way through that, and then we'll get into what the most important scenarios are. And we'll see that there's two very important short-term scenarios. Inflation persists, which is what economists think is going to happen, or inflation falls away quickly, which is what the share market, the bond market, and the money market think is going to happen. And we'll come to the difference of opinion in the next section. But first of all, those two short-term scenarios, whether inflation persists or inflation falls away, and for each of those scenarios, there's a longer-term scenario of whether the powerful deflationary forces that have dominated global finance for the last 4 decades before the COVID-19 crisis, whether those deflationary forces return or don't return. And that gives us a combination of these. The combination of these gives us 4 scenarios, 4 very important scenarios. So we turn first of all to the short-term question of whether inflation persists or whether it falls away quickly, and look at why markets and economists disagree. And it's really all about wages and whether wages have already gotten into inflation. And then we're going to turn to the longer-term question of whether deflationary forces will return. Now, I'll remind you of what I mean by deflationary forces in the first section over here. Then we'll look at what's different in Australia, because principally we're going to be talking about the US as we go through the webinar. But then we'll look at what's different in Australia. And finally, we'll come to which are the best asset classes in the 4 different scenarios for investors in Australia. So that's our talk. Now let's get into it. First part. So why focus on inflation? Now, let me just remind you about inflation, or show you what inflation in the US looks like since 1914. Now, I know in general, we're more interested in Australia, and we'll come to Australia in just a bit, but it's helpful to look at US data because of its sort of dominant role in these things. And I want to show you a long-term picture of inflation to bring a few things out. First of all, that inflation has really zoomed up. This is historically high level of inflation that we have zoomed up to. And we've gone up very quickly, almost as quickly as ever before. It's also true that inflation can fall away quickly. And we've seen that in the past. Now, the markets, as I'm going to show you in just a bit, the bond markets, the money markets, the stock market think that inflation will fall away very quickly. Economists don't agree with that. And we'll see what is the crux of that dichotomy between what economists think is going to happen and what the markets think is going to happen in just a bit. But the inflation has certainly zoomed up here. Now, another thing that I wanted to emphasize here is if we go back to the 1930s, now I know we're going back 90 years, and you might think, well, what's the point of looking back 90 years? Well, the central banks who set interest rates, Australia's central bank, the Reserve Bank, the US's central bank, the Federal Reserve Bank of the US, the European Central Bank, etc., they have a very long-term view of the world. They're not thinking in days or months or years, they're thinking in decades. There's no doubt about that. And really understanding that helps understand their behavior. Now, the nightmare for the US central bank, the US Fed, is that the powerful deflationary force, or the actual deflation that occurred during the Great Depression, returns. So their nightmare is about deflation. They're worried about a deflationary spiral. Now, we've got inflation at the moment, but we've had powerful deflationary forces leading up to the COVID-19, as I'm going to show you in just a moment. And a deflationary spiral is one where there's a shock to the economy, so there's a big hit to confidence. And because of a reduction in confidence, businesses and especially households start spending less. And because they're spending less, there's less demand and prices start to go down. And then the revenues of companies go down, and then companies start laying workers off. So confidence gets even worse, and spending and aggregate demand goes down, and prices go down, and aggregate employment goes down. And there's a downward spiral of confidence, of aggregate demand, of prices, of employment. Now, that downward spiral in the US in the Great Depression took unemployment to 26% across the US and 50% in some states of the US. And so it's a return to that that is the nightmare of the Fed. And it really dominated their decision-making and their choices in the global financial crisis, where we see we actually went into deflation, and in the GFC, where we didn't go into deflation because of the massive response of the Fed. Now, the nightmare that the European Central Bank has, where because that is dominated by Germany, is a nightmare of hyperinflation. Hyperinflation destroyed the German economy after the First World War in the 1920s. And so, when you see the difference in behavior and choices that are made by the European Central Bank and the Fed, and the European Central Bank's greater concern about inflation and the Fed's greater concern about deflation, it's explained by this historical context. So in any case, let's have a look now at the Fed funds rate. So this is the analog in the US. And what I'm getting to here, of course, is why we're focusing on inflation. So, and not something else at the moment in thinking about our scenarios. So the Fed funds effective rate, which is just the Fed funds rate, that's the overnight rate. In Australia, that's called the cash rate. But in every economy, the central bank sets the shortest benchmark interest rate. Now we can see that as the blue line here, and we can see the green line here, which is the consumer price index with the most volatile elements taken out, food and energy. That's the green line here. And the red line is what the Fed really pays attention to, the personal consumption expenditures, the PCE, with the most volatile components taken out. Now you can see how stable the personal consumption expenditure index is ordinarily, and how much it's jumped up. What an extraordinary situation is, just how powerful inflationary forces are at the moment. And that's the thing that the Fed pays attention to. Now, something else to see here is that the Fed, ordinarily we have positive real interest rates. So here we have the short-term interest rate in the US. This is like the cash rate in Australia that the RBA sets, but in the US. And a similar graph to this appears in Australia. But in any case, we see the short-term interest rates here, from which bank lending to households for mortgages and car loans, and to companies for loans to build their businesses. That's what this is benchmarked off, this overnight interest rate, the US Fed funds rate. Now we see real interest rates here. The difference between inflation and the Fed funds rate is this gap between the blue line and the green line. And ordinarily, it's pretty large. And we can see that after the GFC, it went negative because the Fed, to control deflationary forces, to stop us plunging into outright deflation, had to take interest rates down to zero, and inflation ticked along at about 2% or less, 1.5% to 2%. And so we had negative real interest rates, something we're going to come back to some more in just a moment. But the Fed's never been behind, in a sense. We've never had greater negative real interest rates, where inflation is higher than the Fed funds rate. And this is true in Australia as well, inflation minus the cash rate. We've never had as big a negative real interest rates ever as we have at the moment. Why is it all about inflation? Because of just how extraordinary the inflationary circumstances are and how much it's going to affect everything in investing going forward. We don't know which scenario is going to play out, but we really need to to think through the most likely scenarios. Now, let me flag one more thing here, which is really important in this graph, which is this, that just look at the green line, which is inflation. It's actually inflation with volatile parts taken out. The difference between the green line and the blue line, interest rates and inflation, when the Fed's tightening cycle peaks, here, 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 this is when the Fed stops tightening, how much the Fed funds rate is above inflation. Here we had an unusual circumstance, but it's still positive. And then the question is, what happens in this cycle? How much will the Fed funds rate be above inflation when the Fed stops raising interest rates? Now, every instance in the past, when the Fed stops raising interest rates, the Fed funds rate has been a long way above inflation. Why would we expect that not to happen this time around? Just keep that front of mind as we go into these slides. Okay, now the next thing I want to talk about here is about long-term deflationary forces. So a minute ago, I was saying that we need to think about short-term scenarios. So is short-term inflation going to persist? In which case the Fed will have to take the Fed funds rate very high and the RBA will have to take the cash rate very high. Or is it going to fall away quickly? Economists think it's going to persist. The market thinks that the markets, the bond market, the money market, the stock market, think that inflation is going to fall away very quickly. Now, I'll show you what that data looks like and how we know that the markets think that inflation is going to fall away very quickly in just a moment. Those are short-term scenarios. So about what happens to inflation over the next 12 months. On top of that, we need to think about what happens in the 12 months to 36 months, whether the powerful deflationary forces in the world come back or not. Now, what do I mean by powerful deflationary forces in the world? Well, you know that if you've been following this series of webinars, but let me just remind you. If we look at this slide here of the yields on 30-year government bonds in the US, and it's a similar graph in Australia, except in Australia we've only had 30-year government bonds for a much shorter period. It shows the yield on 30-year government bonds, and we can see that there's this secular decline in the yield on 30-year government bonds, where secular here means something that is beyond cycles. It's not the absence of religion. It means in economics secular, something that is beyond cycles. Now we can see cycles here, but there's something that's going on that's beyond cycles. This is the secular decline in 30-year government bond yields. Now those government bond yields are made up of two things, have got two components. So the rate at which investors demand, or the return, the yield to maturity, the return to maturity that investors are demanding for holding government bonds, for lending money to the federal government, is made up of two things. They need compensation for inflation eating into their money, so expected inflation, and then they need a real interest rate on top of that. And a big part of this real interest rate is compensation for interest rate risk. You know, when interest rates go up, the price of these bonds goes down a lot. But in any case, this is the time value of money component, and this is the expected inflation component. Well, this is the real interest rate, and this is the expected inflation component. Now, both of these have fallen in this decline. But here we're focusing especially on this. Most of the decline in real interest rates has been about quantitative easing, as we'll come to in just a moment. But the other part, the bigger part, is the decline in expected inflation, the secular decline in expected inflation, which eventually becomes actual inflation, because inflation is a self-fulfilling prophecy. If people think inflation is going to go up, it will go up, because people will put up their prices, workers will demand higher wages, and vice versa. And this is the secular decline over a very long period of time in expected inflation. Now you can see here that even without a global pandemic, something dramatic was going to happen in the 2020s, in the early 2020s. The central banks are not going to allow these yields to go negative and expected inflation to go into expected deflation. They're just simply not going to allow that. And they're going to take even more dramatic action than they had been taken previously. So if this doesn't turn around in the early 2020s, then central banks are going to take very dramatic action, even more dramatic than cutting interest rates to zero and having, large rounds of quantitative easing. But the global pandemic came along, and of course the stimulus associated with the global pandemic has driven inflationary expectations up and broken us out of this band. But what happens next? That's the question. So do we return to the circumstances of pre-COVID with these powerful deflationary forces in the world, or do we enter a new period? Now, let me just remind you about these powerful deflationary forces. All it takes for inflation to fall is for the growth in supply, in aggregate supply of goods and services, to exceed the growth in demand. It doesn't have to be that either is large or small. There just has to be a difference between the two. Now, of course, what's happened in the last 18 months is because of all of the stimulus, demand has grown faster than supply. And because of that, instead of falling inflation, we've had rising inflation, rapidly rising inflation. So the stimulus in the form of government handout, government checks and quantitative easing has driven the growth rate in demand up here, and inflation has risen very rapidly. But over the last 40 years, what we mostly had is that the growth rate of demand has been lower than the growth rate of supply. And because of that, inflation has been falling. First of all, inflationary expectations, as we can see in those bond yields, and then actual inflation, which follows from that. So what's the problem with demand? Why isn't there enough growth in demand? Well, it's because of these things. It's because population's getting older. You know, the biggest deflationary problems in the world are where populations are aging most quickly. South Korea, Japan, switching to Europe, it'd be Italy. The most powerful deflationary forces are where the populations are aging most quickly. And it's because people start saving for their retirement. Knowing that there's not enough workers to pay taxes to support their retirement, they save more. And more saving means less demand. But more saving would be perfectly fine if we got more investment with it. And I'll come to that in just a second. But another source of excess saving is the concentration of wealth. Wealth has become more concentrated in the developed world since the early 1980s. And wealthy people are less inclined to spend, or they spend a smaller percentage of their income. And so both of these factors have caused excess saving. Now, more saving would be fine. Excess in what sense? Well, excess relative to investment. If all of those savings got invested, then the investment itself, the building of factories and the investment in education or writing software or building mines or whatever it is, then that extra investment would represent extra demand. But there hasn't been enough investment relative to the amount of saving. And it's put downward pressure on inflation. Now, offshoring of jobs has caused a lack of demand as well. And you know, when a job moves from Chicago to Mexico City, for instance, from a job where it's paying $40,000 to a job where it's paying $15,000, the worker in Mexico City isn't much less, if at all, less productive than the worker in Chicago, but that person gets paid less. And so there's less demand. There's the same supply, but less demand. And on the supply side, of course, we have tech advances and globalization, which is bringing huge numbers of workers into the global economy. Hundreds of millions of people came into the global economy over the last 4 decades, increasing the supply of labor. Now, in tech advances, let's just take the well-worn example of Airbnb, for instance. Ordinarily, when you build a hotel is an increase in the supply of rooms available for rent, but it's also construction. And so it's a lot of investment. The building of hotel is a lot of investment of site works and of making out the concrete plates and mechanical and electrical and the architects and everything. So yes, it's an increase in supply, but it's a big increase in demand. And in a healthy economy, these two things ratchet up together with lots of investment. But Airbnb increases the supply of rooms available for rent without anything being built. You know, some platforms being built and a few software engineers and the like. And I shouldn't understate too much what Airbnb represents, but nothing has been built. So this is what I mean by tech advances. And there's an element of that everywhere in the economy. And so what makes up the difference between these two, just to remind you, extra debt is required to make up the difference. And that's why one of our scenarios is referred to as the debt trap. That to get demand up to supply, then we need extra household debt, extra corporate debt, extra government debt, extra central bank debt. That's what quantitative easing is, extra central bank debt. And you'll see that one of our scenarios is called the debt trap, and it's the return to this situation of more and more debt. Okay, now let me just quickly remind you about what quantitative easing means before we go on here. Quantitative easing refers to expansion of the Fed's balance sheet, or whichever country we're in, the expansion of the central bank's balance sheet, and you can see the Fed's balance sheet expanded from before the GFC, around about $1 trillion to $9 trillion today, in 3 rounds of quantitative easing after the GFC, in a long period of time, a short period of quantitative tightening, the unwinding of quantitative easing, and then back to a massive amount of quantitative easing of the creation of new money and the buying of bonds in the COVID-19 crisis. And ordinarily, the Fed doesn't deal with institutional investors. It only deals with the banking system, which then deals with the real economy of households and firms. But in quantitative easing, it's a departure from that. The Fed writes checks, just creates new money by writing checks on itself, just like the Fed can print new money out of sheets of plastic. It writes checks, it buys bonds. That's what all of this is, the buying of bonds, principally US Treasury bonds. The buying of bonds through the creation of new money, creating new money to try and stimulate inflation, to fight deflation. That's what quantitative easing is all about. So the Fed writes checks to buy bonds. It might buy bonds, if this is in the US, it's buying bonds from BlackRock, PIMCO, Vanguard, Fidelity, American Century, etc. If this was the RBA undertaking quantitative easing, which it did a lot of in the COVID-19 crisis, as I'll remind you of in just a moment, then it is the RBA buying bonds from Aussie Super, AMP, IOOF, MLC, etc. But anyway, the central bank buys bonds by creating new money. PIMCO puts the money into Citigroup. Citigroup puts the check into its bank. And now we have the whole circle. Now we have the Fed has more bonds as its asset, and it has the money deposited in the Fed, which is an asset of the banks, matched by deposits of PIMCO. PIMCO used to own $100 million of bonds. It sold the bonds to the Fed in exchange for a check for $101 million. That's why they sold them, because of the extra $1 million. It wouldn't be as big a margin as that, but an extra amount. The $101 million, they put it in the bank, into their bank, Citigroup. Now PIMCO, the big institutional investor, has got $101 million of extra deposits. And that's the liability of the bank. The bank's asset is that the Citigroup, has put the money in its bank, into the Fed. But new money has been created, not folding money, but money in the bank. New deposits have been created. And when PIMCO tries to get rid of those deposits, or by buying new shares, not new shares, but buying shares from someone else or bonds from someone else, to get rid of the zero interest rate deposits or buying commercial property, then that drives the price of all of those things up. So asset prices are driven up until someone's prepared to hold deposits. All of this is the creation of $9 trillion or $8 trillion of extra deposits. And with a little bit of circulation in the economy, actually about $12 trillion of extra deposits. Now, who's going to hold all of those zero yielding extra deposits? Well, no one, unless the alternative to holding deposits of buying shares, buying bonds, buying commercial property becomes too unattractive. So for it to become unattractive, the price of those things and the expected return on those things has to go down, but their price has to go up. It has to be that the price of shares and bonds and property has to rise until people think those things are all overpriced. I'd rather hold deposits than hold those overpriced shares and bonds and property. And so quantitative easing drives asset prices up. It has to go up to get people to stop trying to get rid of the deposits by buying assets and to hold on to them. Now, the process of quantitative tightening is the exact opposite. It's the genie going back into the bottle. It's the Fed's balance sheet shrinking. It's money disappearing from the system. Liquidity is disappearing from the system. It's the deflating of asset prices. It's the exact opposite. That's a really key thing for us to remember. And because we are in a period now of quantitative tightening, the Fed is shrinking its balance sheet by 1% per year. So in any case, we are in a period of unwinding of quantitative easing. The Fed is shrinking from this month onwards, from September onwards. It's been ramping up since June, but now it's fully ramped up, $95 billion per month of shrinking, of money coming out of deposits, of bonds that mature not being turned over into new bonds, of money going back into the system. Now, that have a powerful downward effect on asset prices if it goes on for a long period of time. And we want to think about under what scenarios quantitative tightening will go on for a long period of time in the US and in Australia. Now, this slide is intended to just point out that it's not always about inflation. Sometimes when we think about scenarios going forward for investments, we're thinking about how quickly cash flows will grow. And here I just put this slide up to show you that cash flows have grown tremendously quickly. Cash flows coming out of US companies in the form of share buybacks and of dividends. That cash flows have grown incredibly quickly over the last 20 years. That can't be sustained. And in another situation, our scenarios would be dominated by earnings and cash flow growth, thinking about what's going to happen to them, or thinking about asset price bubbles, such as happened in the dot-com bubble. Or we might be thinking about scenarios associated with what happens after a financial crisis, such as the GFC. Or we might be thinking about geopolitics, such as the deteriorating relationship between China and the United States, or what's happening in Ukraine or the like. So it's not always about inflation, but it's about inflation at the moment because of just how dramatic what's happened in the last 18 months, just how much stimulus there was. So what are the important scenarios? Well, here they are. So what happens in the short run? Does inflation persist? And I'll show you what I mean by inflation persisting in a more accurate way in just a moment. Or does inflation fall away? Does it persist or does it fall away? And persist really means does it stay above the 2 to 3% band that the central banks are targeting, or does it fall into that band quite quickly? Now, the markets think this is going to happen, and most economists think this is going to happen. And then on top of that, for each of those two scenarios, we have the question of whether deflationary forces return or whether they don't return. And so do inflationary forces return? So we go back to the conditions of pre-COVID, or do we enter a new period with lower inflation, with much less powerful deflationary forces? It may be, a lot of people, not that many people, but quite a few people think that decarbonization is the rapid journey of decarbonization that the global economy is embarking on, and only really a tiny way into, but the incredible transformative process of decarbonization is going to reverse these powerful deflationary forces. Let me come to that in just a minute. But for each of these two short-term scenarios, we have these longer-term scenario where the deflationary forces return or not. Now, if inflation persists and then deflationary forces don't return, we will be heading into a period of stagflation. And I'll show you what stagflation means and the effect that it has on markets, the highly detrimental effect it has on markets in just a moment. If it persists, but then it falls away, but then inflation falls away under the returning forces of deflation, that's reversal. And I'll talk more about reversal. I call it reversal because it's the market going down, but then coming back up again. The asset markets will go down under the effect of more quantitative tightening and lower interest and higher interest rates. But then the markets will come back up. If inflation falls away and then deflationary forces return, we'll be back to the debt trap I was describing before. The ideal situation, but quite unlikely in pretty much everyone's conception of this, is that inflation falls away quickly and the deflationary forces don't return. That's what we would love to happen, which is why I referred to it as Goldilocks. Now, this whole webinar is about these these scenarios. So if you think that I haven't described them in great detail here, that's because that's what I'm going to do for the rest of our time together. Okay, now let me describe it in this way. Let me describe the scenarios in this way. Here's the Fed's target range for inflation. And let's go forward from today, several years into the future. Now, in the debt trap scenario, inflation falls away quickly. So we've got inflation here on the y-axis and years here on the x-axis. Inflation falls away quickly, and then eventually the problem for the Fed is to stop inflation falling down to here, is to stop it falling out the bottom of the band, to maintain inflation. Because deflationary forces return in this scenario, we're in this scenario here, inflation falls away and then deflationary forces return in the longer term, then the challenge for the Fed is to maintain inflation. And so we'll be back to the pre-COVID conditions of very low interest rates, close to zero Fed funds rate, and an end to quantitative tightening, and eventually back to quantitative easing, back to the creation of new money to try to create inflation, to stop inflation falling all the way down into actual deflation, the Fed's nightmare. This is what the markets think is going to happen, that we're going to go back to the debt trap. And if this does happen, markets will go up a lot. You know, in the end, it'll be a very difficult situation for the global economy because you can't just have more and more debt, but that'll be some way off. The crisis will be some years off, but eventually it'll be very bad. But in the meantime, because of falling interest rates and because of the return of quantitative easing, pushing asset prices up, it'll be good for bonds and for real estate and for shares. And the market thinks in the long run, this is what happened. If the market didn't think that, then asset prices would have fallen a lot more than they've fallen so far. Now, this is the Goldilocks scenario where the Fed doesn't have to worry about inflation falling out the bottom here. This is the stagflation scenario where inflation does fall away, but only slowly or more slowly than in the debt trap scenario, and it gets stuck. It gets stuck up here above the Fed's preferred range, and it gets stuck because inflation gets into wages. And wages start to rise, and then we get a spiral, an inflationary, a wage inflation spiral. I don't mean to make it sound too dramatic here, but a spiral in the sense that higher wages drive up prices, and higher prices are driving up wages as people demand higher wages to compensate for inflation. Now, if this happens, which many economists think will happen, then the Fed will be stuck up here at inflation between 3 and 4.5%, something like that, somewhere between 3 and 5%. And the Fed will have to take interest rates up here. We'll have to take interest rates real. Remember, I was emphasizing this in the first slide, actually the second slide. The Fed will have to take interest rates up here to cram inflation down into here. Now, that's what's actually happened in every previous cycle. So this is why economists think this is what's going to happen, because that's what's happened in every previous cycle. And, you know, there's good practical and theoretical reasons to think that it's going to happen. And it's happened in every previous cycle since the Second World War. So why wouldn't that happen in this cycle? And you can see why economists and the market disagree here. And I'm definitely putting myself in the economist camp here, but I'm not pretending that anyone has a particular wisdom here. The thousands of highly resourced and highly talented people who work in the bond markets and the share markets and the like, the tens of thousands, that's obviously not to be ignored. It's really what we need to do is to understand the dichotomy here between what economists think is going to happen and what the markets think is going to happen. And there's plenty of people on both sides, right? There's plenty of overlap. Now, in the reversal scenario, what happens is inflation falls away, it gets stuck, it has to be crammed down with positive real interest rates, with the Fed funds rate going above inflation. You know, the Fed funds rate, this comes down to 4%, but then the Fed has to take interest rates to 5% to get this down. But it doesn't go on as long as in this scenario because of returning deflationary forces. The returning deflationary forces help the Fed to get inflation down here. And eventually, those returning deflationary forces put us down into the debt trap. That's the sense in which it's reversal. To begin with, it looks like stagflation, which is really bad for the market, high interest rates and quantitative tightening, but it ends up being eventually like the debt trap, low interest rates, and an end to quantitative tightening and more quantitative easing. Now, I think this is going to happen. I think that there is going to be a reversal. And I think it's quite an opportunity for investors, actually, to in a way that I'll describe as we go along, because I think the market has more to fall, and then there's going to be a reversal and the market will come back. Now, ordinarily, you'd think the market can just see through that with rational expectations, but we live in a very unusual circumstance here. Okay, but I should emphasize that when I say I think reversal is going to take place, obviously not everyone agrees with that. We've entered the world of Sam's opinion in that part. So back to the world economics and science. And let's just look at these scenarios again. So this is the stagflation scenario. Inflation stays high above the Fed's band because of inflation getting into wages and wages getting into inflation. And then the Fed gets no help from returning deflationary forces. And so it has to keep real interest rates and quantitative tightening high for a long time, which will be very detrimental to the markets. This is a world of high inflation and low growth. And down here, it's really the opposite. Inflation falls away very quickly, and then it's a matter of the Fed holding inflation from falling out the bottom of its range. And so this is a world of low inflation and low growth, because remember that returning deflationary forces is a world of low investment. That what has caused these deflationary forces is that there's excess saving on the demand side. There's also supply side issues with the growth rate of supply exceeding the growth rate of demand. But remember, there was excess saving, low investment, and low investment goes with low growth, relatively low growth, but definitely a world of low inflation and a world in which asset prices go up as opposed to asset prices going down. Now, it'll be very helpful if we could have moderate inflation and higher growth, because the deflationary forces don't return, and this is the Goldilocks scenario, but this is relatively unlikely. And this is the reversal scenario that we head on the deflationary side. We head in this direction of high inflation and low growth, but eventually we end up in a world of low inflation and lower growth. So those are our important scenarios. And let me just emphasize here that this is a world of positive short-term real interest rates and also positive long-term real interest rates. We're not really going to emphasize that so much in this seminar, in this webinar. We'll have another webinar to talk about that later on. And we have talked about that a bit in the previous webinars. But this is a world in which the Fed is going to have to cram down inflation without the help of returning deflationary forces. And this is a world in which the Fed is going to struggle to keep, this is a scenario in which the Fed is going to struggle to keep inflation from falling out the bottom. This is a world in which we return to the conditions of pre-COVID, of very low interest rates, of zero interest rates, and end to quantitative tightening and more quantitative easing. So it really matters, you know, and if there's only sort of one thing that you take away from this webinar, it's this, that we don't know whether we are headed here or whether we are headed here, but this is a world of high asset prices, and this is a world of low asset prices. And you might be thinking, this is a slow motion train wreck. Well, it is a slow motion train wreck, but that's a way into the future, and it's not our concern right at the moment. Now, let me just remind you about what I was saying in that graph where I showed you that where the Fed funds rate peaks, what is the difference? What's the real interest rate, the difference between inflation and the Fed funds rate at the point at which tightening is ended? You know, because what most economists say, and I shouldn't sort of emphasize the dichotomy between the economists and the markets too much, but what many economists, and Larry Summers is really the person who sort of leads the voice of economists in this, what they point to is this. In every previous cycle, the Fed has had to take the Fed funds rate a long way above inflation in order to cram inflation down into its bound, when inflation has broken out of here. And here we can see it. We saw it previously, but here's the numbers. Here's the difference between where the Fed funds rate got to and where inflation got to in all of those previous cycles. Now, here's where we are today. Here's the Fed funds rate, and here's inflation. And obviously, we have very large negative real interest rates, and inflation will come down. Everyone's expecting inflation to come down. But how high will the Fed funds rate go, and how much will it slow the economy? Now, this is the real difference in the view of many economies and the view of the markets. Economists think, why is this going to be different to what we've seen in the past? Especially when we look at how tight the labour market is at the moment, as we're going to there in just a moment. We'll see that the labour market's tighter than it's been since the Second World War. All right, now let me just show you a couple of slides about how difficult it'll be if we get into a world of stagflation. Now here we're looking at the price to earnings ratio, historical price to earnings ratio of US shares And this, of course, is the price of shares divided by last year's earnings. So it's how much investors are prepared to pay per dollar of last year's earnings. And we can see a couple of spikes here, the dot-com bubble, the conditions before the GFC, leading into the GFC, and then the collapse in the GFC. But what I really want to focus on is the stagflationary period from the early 70s to the late 80s. Just how little people are prepared to pay per dollar of last year's earnings. And now, these are very volatile, these price to earnings ratios. So it's better to look at the same thing, but cyclically adjust to it. A cyclically adjusted price to earnings ratio. And cyclically adjusting by dividing prices, not by last year's earnings, but the average earnings over the previous 10 years, adjusted for inflation. That's what Robert Shiller's cyclically adjusted price to earnings ratio is. This is considered to be the best measure of whether the market is overvalued or not. And you can see where we are today, relative, and here you can see the conditions of stagflation. So this is from the early 1970s through to the late 1980s. And of course, what we've had since then is one, a massive boom in earnings that was from here to here in the US. And I showed you that earlier on, the cash flows coming out of and this is a largely tech-driven boom in earnings, but especially the decline in interest rates. That secular decline in long-term interest rates has driven this up. If we have a reversal of that, I shouldn't say reversal because reversal has a particular meaning but if we return to the conditions of stagflation, of low growth and high interest rates of the 1970s, then we're going back to this. And if we have a look at real estate, those of you who get my newsletter, and if you don't get my newsletter, then just send me an email and you'll get put onto it. Most likely you do get it, and you don't see it because it's gone into into your spam bucket. So have a look in there. But in any case, in the last newsletter I sent out, this is this graph appeared. And what I just want to emphasize here is that this is the same period of stagflation. So these Australian house prices with inflation taken out, real house prices with inflation taken out. And that whole period of stagflation, the same period as here, early 70s to late 80s, that same period, house prices are falling by 1% per year after we adjust for inflation. It's not just shares that it'll be bad for, it'll be bad for everything. Okay, will short-term inflation persist? So now we're into our scenarios, and we want to think through these scenarios and look at what the disagreements are and what the issues are. So we're on to the first one. Is short-term inflation going to get stuck above the Fed's band? That's what the persist means. And will the Fed have to take real interest rates positive, the Fed funds rate above the level of inflation, in order to cram inflation down, to slow down the economy, and to slow down the increase in prices and wages, increase unemployment, to slow down the growth of wages, to cram inflation down into that period? That's what we're on to now in this question. So will short-term inflation persist? In this slide, I'm just reminding you of what caused inflation, the incredible stimulus from the federal government, the cutting of interest rates to zero, that's normal monetary policy, massive program of quantitative easing, that's extraordinary monetary policy. And on the supply side, we had that people couldn't work, which decreased supply. We had snarls in supply chains. So, we had a shrinkage of supply and a massive growth in demand. And so, of course, inflation has surged. And we have the unhelpful, it's a human tragedy, I know, Ukraine, but economically unhelpful circumstances of Ukraine, and also of the shutdown in China, where China doesn't have a fully effective vaccination program. That may go on for some time. So these things have got to end in order for inflation to come down. So I just sort of, in thinking about whether inflation is going to persist or not, we're just looking here at what caused this big surge in inflation in the first place. So we're weighing up these things in whether inflation persists. A lot of economists think this is going to happen, and the Fed's going to have to take real interest rates positive. And the markets think this is going to happen. And I'll show you the evidence for that in just 2 seconds. The markets think that supply chains are going to get better, that we're going to have slowing global growth, which will crimp demand, the energy prices will go way down, that will have low consumer confidence, which will crimp demand as well and goes with this, and a strong US dollar in the US, which means imports will cost less. And so, the markets, people in the markets are pointing to these things, but a lot of people are pointing to this, and especially this. And it's these two things I'm going to focus on in the slides that are coming here. But I should also point out that there's a lot of housing price effects that haven't appeared in inflation yet in the US. So increases in rents, for instance, which are only, rental agreements are only signed every 24 months, 12 months or 24 months in the US. And it's a big part of CPI in the US. So there's some lagged effects, which means that this is going to come through. In Australia, very high commodity prices, and we'll look more at Australia in just a bit, but very high commodity prices means that we're unlikely to experience this slowing growth that the US, growth, the national accounts figures came out last week, and the Australian economy grew at 3.9% over the last year. But anyway, let me focus on this and then a little bit on this, but especially on rising wages, because this is what the sort of Larry Summers camp really emphasizes, and I find it very persuasive, frankly. And let me sort of show you that. Actually, just before I go on that, let me just run this short ad for my financial educations course. And that's coming up on the 3rd of October. So it's 3 weeks away from today. That comes up, and it runs for 10 weeks. And it is 10 two-hour live classes, but the classes are recorded. They're actually pre-recorded, and they are on demand. So we have a learning management system. We use the Thinkific learning management system. If you can't attend the classes, you don't miss anything. All of the classes they're actually broken up into 20-minute segments to make them easier to watch. But all of the content that's in the live classes is available on demand. And a lot of people come to the live classes, and a lot of people never come to the live classes. They just watch the whole thing on demand. And so those videos and all of the supporting materials, there's about 250 pages of notes and case studies, that all of those things are available on demand online. A lot of people choose to speak to me one-on-one during the course. A lot of people don't because they for whatever reason, for privacy or whatever. Although there's no infringement of privacy in these discussions either, but a lot of people have one-on-one discussions with me about their investment journey. And so it's just intended to provide you with empowerment and to get you to a lot better outcomes. It's a systematic, step-by-step process where I should give you all of the tools to examine your investments and to understand how to do it properly and to bring you up to speed with a really good investment process. So, we go through strategy and the control of your investments. We discuss everything, all the asset classes, family trusts, self-managed super funds, investing in negative gearing, in alternative asset classes, especially investing in shares, etc. It's a very comprehensive course that gives you the feeling of empowerment, because it just lifts the fog of investing and you really know what you're doing. And it brings you up to speed with your investment process that gets you to much better outcomes. Now, a lot of you have taken it, of course, but it's coming up on the 3rd if you know anyone who wants to take it. Anyway, let's keep going here. So go to the website for that purpose. And if you go to the website, you can see a long video, a 60-minute video that really fully discusses the course. Right now, what I want to show you next is this, is how we know that the markets think that inflation is going to fall away quickly. How do we know that? How do we know the markets think that inflation falls away quickly and that deflationary forces return? Well, we know in this way, and the same kind of data that I'm showing you here appears in Australia as well. I'm just choosing to use US data. Now, in the US, you have a vast government bond market. The government has borrowed about $20 trillion in the US, closer to $24 trillion, actually. And sometimes it borrows shorter-term money, 2 years. Sometimes it borrows money for 5 years, 10 years, 30 years, etc. And we can see the yield here, the return to maturity that investors are demanding for lending money for 2 years, for 5 years, for 10 years, for 30 years. Now, as well as those regular bonds, there's a smaller but still very large market for inflation-protected securities. So these are protected from inflation because the value of the bond, the principal on the bond, the amount of money you'll get back when the bond matures, that amount goes up with inflation. So inflation's been 8.6% over the last year. So the value of the bond has gone up by 8.6%. And then the coupons that are paid, the interest payments on the bond, go up by the same amount. And so the interest payments and the value of the bond go up with inflation year by year over the life of the bond. So it's completely protected from inflation. And so the difference between bonds that are not inflation protected and bonds that are inflation protected is the compensation that investors are demanding for bearing inflation. And so it's a measure of their expected inflation in the future. The difference between bonds that are not protected from inflation and bonds that are protected from inflation, because that's the only difference between these two bonds. And it's the same in Australia, where we have the same thing. The market's not quite as big in Australia, but it's the same in Australia. Now, if we have a look at these, you can see here 2.6%. Now, if you go to Bloomberg, you go to bloomberg.com, you'll be able to make your way to this data, which I took straight off Bloomberg. And because I made this slide a few days ago, you might see different figures. These figures change from minute to minute, really, but they'll be basically the same. Investors are expecting, the market's expecting inflation to be 2.6% over the next 5 years and 2.49% over the next 10 years and over the next 30 years. We can see these from the difference between regular bonds and inflation-protected bonds. Now, we can also see what's going to happen with 5 years and 5 years out. So what the meaning of this is the following. If inflation's going to be 2.5% for the next 10 years, and it's 2.6% for the first 5 years, then for the second part, if it's 2.6 for the first 5 years, it's got to be about 2.4% for the second 5 years to get to 2.5% over the whole of the 10 years. It's not perfectly linear process, this. So, it might look like my arithmetic's wrong, but it's not wrong. It's correct. So, here we can see that going out 5 years, the second 5 years of this 10 years, this is what the investors are expecting. And in the second 20 years of this 30 years, this is what investors are expecting. Now, what you can see here is that the market thinks the Fed will struggle to keep inflation from falling out the bottom. And that's what this means, because remember that the markets are anticipating the Fed will fight deflation. This is what the market thinks is going to happen, despite the fact the market thinks there'll be an end to quantitative tightening and more quantitative easing. This is after factoring in the Fed fighting deflation, going back to fighting deflationary forces, going back to fighting deflation just as the Fed did before COVID-19. So this is telling us what the markets think is going to happen in the long run, that we head back into the debt trap. And in the shorter term, what we can see here is that if we have if we're going to have 2.61% for 5 years, if we went straight down over the next 2 years, just think about 10 years broken into the next year plus 9 years after it. So if we're going to have 2.5% approximately over the next 10 years, and we go down to 2.5% for the last 9 years, in the first year, that means the next year from now, we can only have 3.7%. So this data is telling us the markets think that inflation over the next year will be 3.7%. And then it'll go down to 2.5%. And the extra above 2.5% is why the 5-year rate is higher. But then we'll get down to here, to the 2.5%. Now, inflation's at 8.6% at the moment. And the markets are saying we think it's going to be 3.7% over the next year. Well, if it's 8.6% at the moment and it's going to be 3.7% over the next year, it's got to fall off a cliff. We have to have prints We had to have several inflation prints, month after month, of zero inflation. That's what has to happen. That's what I mean by falling off a cliff. And to a lot of economists, that's just implausible. And it's implausible because of the conditions of the labour market, that inflation will fall to zero when the labour market and demands for increases in wages are so high at the moment. See, this is the crux of the difference between what a lot of economists think and what the markets think, right? And look, and that's the quandary, right? Whose view do you go with? What logic do you go with here? I mean, the markets are never to be ignored, okay? I mean, that's real, that's smart people working with their own money. So it's not to be ignored. But economists aren't to be ignored either. Maybe you have a different opinion about this, but you know, people like Larry Summers are not to be ignored either. And let me show you what the data is sort of behind that, the tightness of the labour market, and you'll see what I mean. And that's where we're going now, is just to look at how tight the labour markets actually are. So what we have here is hourly earnings. You can see how much they've surged. You know, hourly earnings are up above 5% now. And a much more enduring thing is the employment cost index, that's the thing that the Fed typically looks at. And only comes out quarterly, unfortunately, but it's really surged. And this has a lot of momentum, the employment cost index. This is wages. This is inflation getting into wages. This is workers in a tight labour market demanding higher wages. And this thing is heading up and it has a lot of momentum. And, you know, the idea that that's just going to fall off a cliff, well, anyway, I've had my say on that. Let me just show you some other things about how tight the labour market is in the US. So total level of employment, unemployment is back to where it was before COVID-19. The total level of employment in the US is above where it was before COVID-19. The thing that hasn't recovered in the US is the participation rate. There's a whole lot of people missing from the labour market, which is very unhelpful, of course, and it makes the labour market even tighter than it would be otherwise. There's a whole lot of people missing from the labour market who haven't returned, including people between the ages of 25 and 54, which is the most surprising thing, that there is a slice of the labour market that hasn't returned. Anyway, what this is showing you, what this graph is showing you, is how many job openings there are per unemployed person. So ordinarily, if we go all the way back to the Second World War, on average, for every 10 unemployed people in the US, and the figures are very similar in Australia, for every 10 unemployed people in the US, there's 7 job openings. And so that sort of 0.7 of the ratio of job openings to unemployed people, that's the average going back to the Second World War. Well, at the moment, that's 2. There's 20 job openings for every 10 unemployed people in the United States, 3 times higher than normal. It's the tightest labour market since the Second World War. And in some respects, it's the tightest labour market ever. You can see it was heading up before COVID-19, but it's absolutely rocketed up, that ratio. Now here, what you can see is vacancy rate. So this is the number of jobs available as a percentage of the labour force, and this is the unemployment rate. This is people who don't have a job. And you can see how this evolves through time. So this is pre-GFC. The unemployment rate's going down, and the number of jobs, the unfilled jobs, available jobs, is going up. Pre-GFC, and the boom pre-GFC. And then, of course, in the GFC, unemployment goes way up, and the jobs available goes way down. So we go down to here. And then we have a recovery period after the GFC with all the stimulus from the government and from the central bank. And then that continues all the way up to the beginning of the COVID-19 crisis. And then we're back to here. So unemployment goes to 15% in the US. And there's actually still quite a lot of jobs available because there's just, there's just a huge number of people who can't make it into the workforce because of all the lockdowns. But anyway, we have this recovery period, but we end up here. This is where we are now. This is how extreme it is, the tightness of the labour market. Unemployment way down here at 3.6%, and a huge number of vacancies at 7.2%. So, in many ways, the tightest labour market ever. And so to many economists like me, the notion that inflation is going to fall off a cliff when we've got rising wages already growing at 5% in the US, and labour market that tight, it just seems implausible. Now I'm turning to how much money there is unspent in the US. And let me just show you here that this is the checks that were sent to people, first of all by President Trump, and then by President Biden. A vast amount of checks, in total, 12.5% of GDP. Now, when we say demand deposits here in the US, what we mean by demand deposits is that these are the checking accounts that people use not for saving, not for storing up cash, for saving for their retirement. Those are in term deposits. These are just their working checking accounts. And the sawtooth pattern is simply caused by the fact that this is people, this is people going from month to month or fortnight to fortnight with their wages. If we had a higher frequency of data here, then we would see an even tighter sawtooth pattern. Now, that's money held by ordinary US families that are not very wealthy, that we expect them to spend, but they haven't spent it yet. So this is demand that is sort of waiting to surge into the US economy. And it's a lot. It's 12.5% of GDP. These are the unspent checks, the part of the stimulus that hasn't made its way into demand yet. It's the sort of stored up inflation. Now, the people who think that it's going to fall quickly, they point to these things. They point to slowing global growth. And here we're looking at the IMF figures. And month by month, they are showing slower and slower global growth. They're showing the slow economic growth in the US. In the previous quarter in the US, there was, this is in personal consumption terms, but total personal consumption. But in GDP terms, there was a negative print in the previous quarter. They point to very low consumer sentiment. So consumer sentiment in the US, and in fact throughout the developed world, is very low, at historically low levels. And you would think that the epidemic is finished, hooray. Employment is very high and there's jobs everywhere, hooray. People's house prices are way up, hooray. You would think that consumers would be happy, but they're not. They're the opposite of happy. Consumer sentiment, and as I said, it's not just the US, this is everywhere in the developed world. And this is not well understood. We don't know, actually, why consumers are in such a big funk at the moment, but they are. And that's why they haven't spent the money yet. And people who think that inflation is going to fall off a cliff, they really point to this. And they also point to the strength of the US dollar. And here I'm just sort of showing in some graphs the strength of the US dollar. Now, will deflationary forces return? We don't know. And let me just sort of emphasize a couple of things here. That it may be people who think that deflationary forces will recede, and most people do not think that. Most people in the markets and most economists think that those deflationary forces come back. Mostly they think that those deflationary forces never went away, that they've just been masked by the stimulus in COVID-19, causing short-term inflationary stimulus. And that eventually that sort of sugar hit from all the stimulus will pass through the system and we'll be back to the decades-long deflationary pressures that we've always had. Now, not everyone agrees with that. Most people in the markets and most economists think that that's what's going to happen. But not everyone agrees. And people who don't agree, like Nouriel Roubini, for instance, would be the leader of people who don't agree with that. They think that demographics have changed, that there's been a big shift in power to developed country workers. They think that globalization has really come to an end. Roubini goes on and on about that, about the slowing of globalization. People also point to decarbonization, and I didn't put that in here, but increasingly people think and talk about that and study it. And decarbonization means a massive amount of investment in the new technology in batteries and, solar farms and wind farms and the like, hydrogen, etc. Tens of trillions of dollars, maybe hundreds of trillions of dollars in the end, of new investment in decarbonising the global economy. And so that investment is reversing the problem of excess savings, clearly. And it's also true that or I should say, people also point to high energy prices, which we're experiencing already in the electricity grid in Eastern Australia, not where I live, in Western Australia. We've got plenty of cheap gas, but high energy prices, inflationary, all that investment, tens, maybe hundreds of trillions of dollars of investment, reversing deflationary forces or unwinding deflationary forces. So look, I acknowledge that, but I'm in the camp that thinks that deflationary forces are coming back. But these are very, very powerful and enduring. And in some ways, they're worse. You know, that the aging of populations has been accelerated. Because birth rates are down in developed countries, the problem with aging populations has been accelerated by COVID-19. The tech advances mean that with remote work, see, the issue with work from home is that home, instead of being my home, might be a home in Manila, or it might be a home in Montevideo, or Kinshasa, or somewhere, or Budapest or somewhere. That the tech advances of remote work will subject white-collar workers to the global pressures on their employment that blue-collar workers have experienced for the last 4 decades. It'll bring that global pressure on employment to knowledge economy workers that has been on sort of industrial economy workers for the last 4 decades. And that'll be very powerful deflationary force. So look, I acknowledge these other parts and the decarbonisation argument, but I'm definitely in this camp. Not everyone agrees, but most people are in this camp. So what's different in Australia? I'm not going to dwell on this too much, or I should say I'm just going to go through this very quickly because there's some other things I want to get onto, and we need to speed up here. So inflation is not as high in Australia, but there's reasons why it's lagged in Australia. And one of those is that we have centralised wage fixing in Australia. We have awards and we have enterprise bargaining agreements, which are slowing down inflation getting into wages. That doesn't mean it won't happen. It just lags the rate at which inflation is growing. We can see that the inflation that we do have in Australia is mostly about goods inflation, but ordinarily it's mostly about services. The service component hasn't appeared yet. So there's something big and stored up that's coming. This has really got the RBA worried that we haven't had the surge in services inflation yet. Wages, as I said, haven't grown so much in Australia. It's also true that in Australia, that unlike the US, participation has actually gone up in COVID-19 and not down, which is a very healthy thing on lots of dimensions. This is a measure of wage growth, this is SEEK for the first time using their data on jobs being advertised to make an index of wage growth. Now, they only released this month for the first time. All of this is them working backwards through their data. But it does appear to show that wage growth is quite a lot higher in Australia than the ABS figures are showing so far. Then we have the RBA. So this is really just showing actually not a difference between the US and Australia, but that the shrinking of the RBA's balance sheet. The RBA expanded this balance sheet. We didn't have any quantitative easing until COVID-19. And then the RBA undertook a massive program of quantitative easing. And the RBA's balance sheet became 26% of GDP, which isn't that far behind the US. You know, we went from 5% to 26%. We went from down here to way up here in Australia because of the buying of bonds and also the term funding facility, which you would have heard me talk about in previous webinars, and I'm not going to worry about too much here. But there's a lot to be unwound in terms of our balance sheet. I guess that's the main point. Now, another really key difference in Australia is that we are experiencing a commodity boom, the greatest commodity boom Australia's ever seen. You know, if we took this graph all the way back to the Korean War, we'd see the previous high point, but that's only up here. Commodity prices at the moment are the highest they've ever been. Now, you know, we are, as much as we love to think that we're a knowledge economy, and we are, of course, a knowledge economy. You know, I'm engaged in that and teaching at the University of Melbourne. teaching foreign students at the University of Melbourne. We are a knowledge economy. But at the heart of our economy, we are still a small, open, resource-based economy. And the notion that our small, open, resource-based economy, experiencing the highest commodity prices ever, is going to suffer a major slowing or a several quarters of recession, which is what would be consistent with inflation falling off a cliff from where it is at the moment. It's implausible, quite frankly. There's really no way Australia is going into a big recession with commodity prices like that. Commodity prices will absolutely have to fall off a cliff for that to happen in Australia. All right, let me speed up a little bit here by getting into this. What do these asset classes mean for different inflation scenarios? Let me sort of bring these things out. So I'm just going to jump forward here to something, which is this. As well as considering, the high inflation, low growth of stagflation and the reversal scenario, stagflation turning into the debt trap, etc. Something that I really need to emphasize here is real interest rates. What we have here is that real interest rates have changed a lot over time. So we need to think through what's going to happen to real interest rates in different scenarios. There's a danger I'll run over time here, but it's worth spending a couple of minutes on this. Now, what do I mean by real interest rates? Well, here's the cash rate. And if we subtract out inflation, we have the real interest rate. The cash rate minus inflation is the real interest rate. And if we go back to before the GFC, that's going to be 2 to 2.5%, all the way back to the floating of the Aussie dollar and the deregulation of the banking system. This is going to be 2 to 2.5%. And then after the GFC, and especially after 2012, this comes down to 0. This means that the cash rate and inflation are approximately the same thing. And since then, and especially in COVID, this has fallen off a cliff. So what we have at the moment is we have 2.35% as the cash rate, and we have 6.1% as inflation. So we have minus 3.75%. Now, the importance here for investors is this, that when you go from a positive real interest rate to negative real interest rates, it turns lenders into borrowers. Here, if you're borrowing to invest, in your negative gearing strategy, you are paying someone else to use their money. So they are getting inflation plus this real interest rate for you to use their money in your investment. Well, down here, they are paying you to use their money. Now, look, if someone comes around and says to me, look, Sam, I'll mow your lawn and wash your car and clean the swimming pool for you. Now, our kids have all moved out of home, so definitely need someone to do that. If someone comes around and says that, and they say, and guess what? I'll pay you to do it. How many days do you want me to come around and do that each week? Well, a lot, right? You're going to come around and work on my garden and pay me to do it. I want you to do a lot. And it's the same with capital as it is with labor. How much do people want to borrow in general when we go from here to here? This is a world in which lenders are getting paid for other people to use their money. And this is a world in which people are paying for other people to use their money. It turns lenders with the money in the bank into borrowers, people taking money out of the bank and using it in investment. Now, you need to bear that in mind. And the reason I'm bringing it up here is because different scenarios have different outcomes. In the stagflation scenario, this goes positive. In the stagflation scenario, the RBA has to take the cash rate above inflation. So this blue line has to go back to 1 to 1.5%. And it'll be bad for borrowers, for people borrowing to invest. It'll be difficult. In the debt trap scenario, this stays negative for a significant period of time. So it really matters which scenario we're in terms of borrowing to invest. It's absolutely first order. And it's the thing to really think about. It's absolutely central to your investment strategy to think where we are heading here, which is, of course, why I'm discussing it here in the webinar. Now, let's just jump forward here and think a little bit about these different scenarios. So you can see here, in the stagflation scenario, what kind of assets do we want to be in? Well, we don't want to be in growth assets. Rising interest rates are very hard on growth assets. And just look at what's happened to tech shares in the US. They're down 30% because they're growth assets. And once people get the feeling that that growth that's built into the price isn't there, they don't go down a small amount, they go down a lot. So assets that deliver income, that what you're buying into is high income today rather than a promise of high growth in the future, are going to be better in this scenario. And low debt, for the reasons I was just talking about, because of positive real interest rates. And that means these kind of things. High yielding shares, floating rate notes, which have got protection against inflation, commercial property, which is both a value asset. You typically don't borrow a lot of money to invest in commercial property, and is a value asset instead of a growth asset. These are the kind of things that people are going to want to be in if we're heading into this scenario. And down here, people are going to want to be into growth shares. You're going to want to be into fixed rate bonds because interest rates are falling and bonds will go up in value. You're going to want to be into negative gearing strategy into houses. Negative gearing is a growth strategy. If you don't know that, then take my investments course and you'll learn all about it. Negative gearing is a growth strategy. And so this is a world of more of a world of commercial property and apartments and the like. And this is a world of negative gearing, of borrowing money to invest. And so here I'll just sort of put down some subjective, let me really underline 3 times subjective. This should really say Sam's probabilities of what's going to happen. But I've been explaining to you this dichotomy between what the market thinks and what economists think. But most people think that deflationary forces are coming back. I think that this is going to happen. The markets are going to do. I can tell you what my strategy is going to be. Nothing in this represents financial advice, by the way. I'm not telling you what to do. I'm explaining to you what I think is going on the basis of economic theory and data. And now I'm telling you what Sam is thinking about in investing in his own portfolio. And what I'm thinking about is the asset prices are going to go down, but then they're going to rebound. And when they do rebound, it'll be into a world of negative real interest rates. So I'm thinking I'm just going to keep my powder dry until we start to rebound and interest rates start to fall, especially real interest rates start to fall and asset prices come up. And so low debt levels or lower debt levels aren't that easy to change, but lower debt levels and going through here and higher debt levels going through here. I'm expecting the market to go down and then to rebound. Now, let me just say one last thing here. This really is the last slide. And it's about negative gearing. I just want to make out a couple of points here. I know I'm way over time, but you'll be glad that I discussed this, I think. That thinking about negative gearing, because I know a lot of you have got negative gearing, negatively geared properties, about what works in terms of negative gearing in the different scenarios. So if we are in stagflation, the problem with stagflation for a negative gearing strategy is that you don't get any real price growth. Negative gearing is a growth strategy. It's a strategy of turning pre-tax income that would be taxed at very high rates, instead using that to support your negative gearing strategy, to make up the difference between interest payments and rent. So it's a strategy of turning pre-tax income into capital gains. Now you can get capital gains from real price growth. That's what we really like, is real increases in prices. But inflation will do. You just need to turn income into capital gains for negative gearing to work, because of the capital gains are taxed at such a much lower level, at half the level of income. because of the capital gains discount in Australia. So it's really a strategy of turning income into capital gains. This is what we really want, but that will do. And in stagflation, we won't get that, but we will get this. But the cost of borrowing is high. And that's why it's difficult. And over here, you won't get the benefit of inflation, but you will get real price growth as interest rates fall and house prices rise as a result of it. And you will have a very low cost of capital helping you. And in a reversal scenario, of course, you move from stagflation to the debt trap. So now we're at the end of the webinar. What's the main takeaway? What's the one most important thing in the webinar? Well, it's this. So in the stagflation scenario, inflation will only fall slowly. It'll stall at this level, and the Fed and the RBA won't get the assistance of returning deflationary forces to cram it down into their preferred range. And so we're going to have large, positive, short-term real interest rates. Now, that'll have very important effect on the markets. We'll see that in stagflation, the markets will go down a lot, as I showed you in the webinar, but also it'll be important for borrowing, for investors thinking about borrowing, and this is a world in which you want to have less leverage. And the alternative, or the opposite scenario, we should say, is that inflation falls away quickly, that the Fed and the RBA do receive assistance from returning deflationary forces to drive inflation down, and then it becomes a battle to keep inflation from falling out the bottom of the range. And the long, decades-long battle against deflation is rejoined. And so this is a world of higher asset prices and negative real interest rates. Now, we don't know which of these scenarios we're going to go into. This, I think, is much more likely than this. I'm leaving out the scenario that I think is most likely, which is reversal here. But the point that I really want to make is that the thing to watch is wages. If wages get stuck in inflation, become incorporated into inflation, then we're going to be in the stagflation scenario. And it'll become very difficult to cram inflation down into that level. So watch wages and whether wages is becoming incorporated into inflation. That's the most important thing. So I hope you've enjoyed this webinar, that you'll join me for future webinars in this series. If you are watching this webinar, but you are not connected to us, then send me an email or go to windlestone.com.au and sign up for the newsletter, and then you'll receive the invitations to future webinars. Okay, now let me just mention, just before I go, my Finance Education for Investors course, which is starting on the 3rd of October. If you've already taken the course, then please tell your friends about it. If you haven't taken the course, then please go to windlestone.com and check it out. It is a comprehensive course intended to give you empowerment through knowing how to undertake your investments and to get you to better outcomes by taking you through a structured process, a 10-step structured process, one step for each week, to bring you up to step with a proper investment process, including strategy and control and goals and positioning on the risk spectrum and everything. You'll love it. Starting on the 3rd of October, so soon. Okay, thanks for participating. See you in the next one.